Okay, Mukesh Patel here. Let's talk about Entrepreneurship Law 101 for founders. First important issue that we have to address is what kind of entity should we select for the company? And if we select the wrong one, can we then transfer or transition or revise it if and when necessary? And then what kind of structure should we use for forming our company? So let's get started. There are numerous types of business organizations, uh, almost 10 of them. The first one is a sole proprietorship. This is where one individual just starts a business without forming any company. They're essentially using their own name and they're in business. They start doing business for profit. They have customers, collect revenues, pay expenses, and it's basically on them, on their own name. Sometimes they could have a different name than their own natural given name, like let's say a alternative name, a fictitious name, sometimes known as DBA, doing business as. It doesn't matter if you have that additional name. If you're just doing business on your individual name without a formal, separate, and distinct entity, that's not good. There's a lot of risks, exposure to liability, and very hard to get investment in a sole proprietorship. So we'll talk about that. If you have two or more people doing business together for profit, it's typically known as a general partnership. For a general partnership, you do not need to incorporate or set up an entity, just like a sole proprietorship. You just have two or more people and you start doing business. Again, not recommended because of the risk associated with it. There is another form of partnership called limited partnerships, where now you have two types of partners. You have one or more general partner that takes on the liability, and then you have limited partners known as LPs, general partners known as GP. With limited partners or LPs, they are typically investors who invest in the company, and they are not typically active in the business or operations. Hence, limited partners do get protection under the law from exposure to liability, but a general partner does not get protection. So therefore, if you are setting up a limited partnership, the general partner may want to incorporate the GP as an entity for that protection. The types of businesses that typically do limited partnerships are investment funds or professional service companies sometimes. So it's not something that a high-tech startup founder or a high-growth startup company would typically do. The funds that invest in them, like angel funds, venture capital funds, sometimes private equity funds, may be in the form of limited partnerships. The fourth one is limited liability partnerships. This is even a more unique, nuanced type of limited partnership, typically reserved for professional firms like law firms, accounting firms, sometimes medical practices in certain states. So that will not be something we would really look at or use. Number 5 is one option for small businesses or family businesses, SMBs, small medium businesses, or SMEs, small medium enterprises. Startup companies sometimes also do LLCs, limited liability companies, but it is not the ideal form of entity if you want to raise sophisticated capital from angel groups and venture capital firms or private equity firms. We'll talk about that in a second, but it is something that many small businesses start as, so we will touch upon that. The ideal type of entity for high growth companies looking to raise capital are in the form of C corporations. A C corporation is the default corporation when you incorporate an entity or incorporate a corporation. it's going to be a C corporation by default. Then there is a special type of corporation known as Subchapter S corporation. It is typically based on the tax code where there are certain advantages and limitations or restrictions that you have to comply with in order to be a valid Sub S or Subchapter S corporation, sometimes known just as S Corp. And then there's this relatively newer type of entity called B Corp or benefits corporations. We'll talk about that in a moment. Some of the considerations in selecting the entity will include the formation process, which one's easier, faster, flexibility, what kind of entity gives you flexibility of ownership versus management or vote versus profits and loss distribution. The third are what type of documents you would need depending on the different types of entities, what kind of management structures are acceptable or typical in these different types of entities, and then which one gives you protection against unlimited exposure to liability. So if you take these 5 things plus costs and tax structures, if you take those things into consideration, for some entities it does take longer. The law firm might need more time because of extra paperwork, or certain states might have additional requirements like publishing in newspapers, for example, for a certain prescribed number of times in order to properly comply with the incorporation process. Taking all of these considerations in mind will help you identify the best type of entity. And the last consideration is what your investors prefer, or what sophisticated investors typically prefer. So let's go through this. I've created a simple chart that goes through these different types of entities, the most common ones from sole proprietor, GP, LP, LLC, C Corp, and S Corp, and measure that across the considerations of formation, governing docs, ownership, management, certain tax considerations, and liability considerations. At the end of all that, let's simplify this into what type of entity you really should have. So here's the simple algorithm for this. If you are a lifestyle or a small or family business looking to grow, but not necessarily looking for external capital and hyper growth, so you're looking for nice stable growth or fast growth, but not the kinds that you might see tech startups go through, then an LLC is often the preferred route, or a corporation, which could be a C Corp or a S Corp. However, if you're seeking to build a high-growth entrepreneurial tech company like unicorns, companies that have the potential to reach $1 billion valuation as a private enterprise without doing an IPO, an initial public offering, and you're seeking to raise external capital, angels, angel groups, venture capital firms, private equity, then the preferred entity is often a C Corp. If you have formed an LLC, you may need to convert to a C Corp, and that there is a process by which to do that. Your law firm and accounting tax firm should be able to counsel you through that process. Typically takes about 30 days plus or minus, and might cost anywhere from a few $1,000s to $5,000 to $10,000 to do that. If you are doing an LLC, it does give you flexible ownership, management, equity, and profit and loss, which means that a 25% equity owner in an LLC could have 50% vote from a management perspective and have different ownership and profit and loss distribution percentages. There is single taxation because it's a pass-through entity, So the entity typically is not going to pay federal income tax on the profits. Everything is passed through to the members. The members are like shareholders, they're owners of the entity. So there is single pass-through taxation, which is a pro, it's a benefit. Certain states like New Jersey might have certain fees, like annual reports and fees that they charge. Typically, in a state like New Jersey, if there are two or more than two members, then on an annual basis, there might be a fee per member of approximately $150 plus or minus. So if you have 5 members or 4 members, let's say, that could be $600 per year, 150 times 4, just for that additional fee. There also may be some self-employment taxes that could be hit as well. Again, if you are an LLC and you need to convert to a C Corp, that might be a possibility. The con of this entity is that equity structuring sometimes appears to be a bit more complex and a bit more costly than if it was a standard corporation. Let's look at a corporation. Investors typically prefer this because it's the type of entity that they're used to investing in and works for them legally, structurally as well. The structures are fairly standard and easier. So most law firms, accounting firms, tax firms, and investors will have seen it, will have done business with C Corps, and they're used to it and they like it. One con or negative is that there is a double taxation. For example, the corporation will have a federal income tax on the profits. And then when you do distributions to the shareholders, that's a second layer or level of tax as well. So there is this option called sub-S status. The benefit is that it allows a corporation that has elected sub-S status to get the benefit of single taxation. There is a strict limited time in which to select this option. Typically, it's within 75 days of incorporating. You have to file a special form for Subchapter S election. There may be exceptions to that timing, but if you miss the deadline, then you may not have the option and you'll have to remain a C corporation. There are certain requirements or compliance requirements, such as the shareholders must be permanent residents. It does not require green card status, although that is sufficient, but typically it is not meant for investors that are foreigners or live in foreign countries and are not permanent residents of the United States. There's also a cap of 100 shareholders. If you expect more than that, the sub-S may not be an ideal structure. And you're only entitled to have single class of stock, unlike C corporations where you can have multiple classes of stock. You can have Class A, Class B, common stock, preferred stock, all types of different rights and responsibilities attached to different classes of stock. In a sub-S single class of stock, however, voting and non-voting shares are permitted without violating that requirement. And then essentially it's almost exclusively for individual stockholders. So corporations or multi-member LLCs may not be permitted as a member of or shareholder of Subchapter S corporations. So these are the 4 most, not popular, but 4 of the most important constraints or compliance restrictions to satisfy the status as a sub-S corporation. A B Corp, a benefits corporation, is perhaps the newest class of corporation. It has a higher purpose or a corporate purpose to create material positive impact on society, let's call it social innovation or social impact. It can be society, the planet, the environment. Think about ESG goals or kind of a social entrepreneurial venture. So the entity can be B Corp. Many states now permit that as a separate type of entity, but you don't have to do that. You can go to an agency or a company that provides B Corp certifications. That means if you comply with their requirements, you could be a C Corp with a B Corp certification. Sometimes you can be an LLC, being treated as a corporation for tax purposes. Maybe that can be entitled to a B Corp certification. There's a lot of nuances and you should look into the details, but know that this is an option. The other is that you can be a C Corp with authority to make decisions for social impact like a B Corp would, and then you would have that authority to do that without forming a B Corp or without being B Corp certified, because there is a fee associated with becoming B Corp certified. So that's another way, without much cost or time, to still have the authority to do social impact through your company, just by making sure your certificate of incorporation and bylaws, shareholders agreement, expressly permits the founders and the owners to take into consideration and make decisions that are social impact related. Now, when you form an entity, it is not a federal filing, it's a state filing, so you do have to choose which state you want to incorporate in. If you're in New Jersey, every state will have its own website that you would go on to learn about the different types of entities. Typically, in our cases, it's going to be LLC or C Corp, and then you can incorporate. You can also do it through legal counsel. We'll share with you resources on how to find these attorneys that specialize in startup law, corporate law, securities law, and things like that, or even tax law. Most companies will incorporate in Delaware, in the state of Delaware. The website is listed below. Now, why Delaware? It's because it was or is considered the first state. It has clear established corporate law. Many Fortune 500 companies are incorporated in Delaware. Approximately 80% of all new corporations have been incorporated in Delaware in many of the years. It gives comfort and is the preference from an investor's perspective. Even attorneys and accountants often prefer that because they're used to it. It's standard practice, and many investors prefer to invest in a Delaware corporation as opposed to some other state that they now need to spend additional time and money to understand the compliance requirements. Your company's office does not have to be in Delaware, so you can be located somewhere else with a physical location or employees or bank accounts in any state and be incorporated in Delaware. However, talk to your attorney about whether it's necessary to file an authority to do business in a foreign jurisdiction, meaning a different state than Delaware, if you are located somewhere else, or do business in another state. That's a relatively straightforward process that the attorney can handle for you so that you can be physically located in another state, incorporated in Delaware as a Delaware C Corp, doing business in New York, New Jersey, where have you. Next module, we'll talk about financial and tax considerations.